The most dangerous tax mistake in retirement does not happen on the 15th of April. It happens on the first quiet Monday morning after your last paycheck. For 30 or 40 years, a machine handled your taxes for you. Your employer withheld money. Payroll sent it out. Medicare came out. Social Security came out. Federal income tax came out. You complained about it, but the machine worked. You lived inside the machine long enough to mistake it for nature. Then one day the paycheck stops. And most people think what stopped was work. That is not what stopped. What stopped was the system that protected them from themselves. I have watched people spend an entire lifetime building a respectable retirement and then lose thousands of dollars in the first 2 years because they walked into retirement with an employee-s tax brain. They thought the old system was still running in the background. They thought somebody else was handling the details. They thought the IRS would send some neat little welcome packet explaining what to do next. The IRS does not send a welcome packet, it sends penalties. That is why I want to speak plainly. If you are retired or close to retirement, you are no longer living in an automatic system. You are now the chief financial officer of your own household. Every withdrawal, every withholding election, every distribution, every form, every deadline, every choice now belongs to you. And the cost of not knowing that is not theoretical. It comes out of your checking account, your Medicare premium, your Social Security check, your IRA, and in too many cases, your peace of mind. When I was younger, I learned something simple about money. Systems beat intentions. A person can have wonderful intentions and still get destroyed by a bad system. Retirement taxes are exactly like that. Most retirees are not careless. Most are not dishonest. Most are not reckless. They are simply walking into a system they do not understand. So I want to give you the version nobody gives on your last day of work. I want to tell you what the IRS begins expecting from you the moment the paycheck stops, and I want to do it in the language that matters, not the language of tax brochures, the language of traps, timing, and consequences. The first mechanism is what I call the autopilot collapse. While you were working, taxes were invisible because withholding did the heavy lifting. Your employer was your tax collection agent. Your retirement plan contribution came out, your federal withholding came out, in many cases, your state withholding came out. You did not need discipline because the structure gave you discipline. That is how most people live for decades. Then retirement begins and income starts arriving from 5 different directions at once. Social Security, a pension, IRA withdrawals, dividends, interest, maybe rent, maybe part-time work, maybe a taxable brokerage account, throwing off capital gains at exactly the wrong time. Each stream looks harmless by itself. Together, they create a mess. The retiree thinks, I have less income. Now, so my taxes should be simpler. Usually the opposite happens. Why? Because withholding in retirement is often too small, too irregular, or missing entirely. Social Security does not automatically solve the problem for you. IRA distributions can be withheld in a way that feels adequate, but turns out to be laughably low once all the other income hits the return. Dividends and interest can quietly stack in the background. Then April arrives and the retiree discovers 2 things at once. First, the balance due is far larger than expected. Second, the IRS has added a penalty because the government does not care that nobody explained the rules to you. That is the first insult of retirement taxation. You can owe tax on money you already spent and then get fined for not prepaying it in the pattern the government wanted. This is why estimated tax payments matter so much. Not because the concept is exciting, because the penalty for ignoring them is stupid, preventable, and permanent once you let the year slide by. The quarterly pattern is the new payroll system. If you do not have enough withholding elsewhere, you can resent that. You can roll your eyes at it. You can call it bureaucracy. None of that changes the fact that if you do not replace the old automatic machine with a new one, you become the machine. Fay-site, Fay-turn, 490155, search 0, Fay-turn, 490155, search 8, Fay-turn, 490155, search 16, Fay. And here's the part that really bothers me. There is even relief available for some new retirees who underpay, but many never claim it because nobody tells them the waiver exists. The government will happily collect a penalty from people who did not know they had to ask for mercy in the first place. That is not a financial problem. That is an ignorance tax disguised as procedure. The second mechanism is the Social Security trap. Most Americans are taught to think about Social Security as a benefit, and that is how it should be viewed emotionally. But the IRS does not look at it emotionally. The IRS looks at it through a formula. Once your other income rises above certain thresholds, part of your Social Security becomes taxable. The cruel part is not simply that this happens. The cruel part is that the threshold stayed frozen for decades while everything else in life got more expensive. That means more and more retirees drift into the taxable zone not because they became rich, but because the world moved and the formula did not. Faysite Fayturn 490155 search 5 Fayturn 490155 search 13. I have seen retirees make the same mistake over and over. They look at the check and they say, this is my Social Security. Then they look at their IRA and say, this is separate. Then they look at some tax-free interest and say, that should not matter. Then April arrives and they discover that the government ran all of it through a provisional income formula that changed the taxation of the benefit itself. That is the hidden blade. Retirement is full of income that does not just get taxed. It changes the tax treatment of other income around it. One extra withdrawal can have three effects at the same time. It can be taxable by itself, it can cause more of your Social Security to become taxable, and it can move your total income into a zone that creates a second-order consequence later, especially with Medicare. So before you tell me your bracket is 12% or 22%, I want you to ask the only question that matters. What is your real marginal rate after all the interactions? That is the difference between a retiree who still thinks in boxes and a retiree who understands systems. Now, if you know that Social Security may be taxable, you should immediately ask a practical question. Can I withhold from it directly and reduce the surprise? Yes, you can request voluntary withholding from Social Security instead of pretending the problem will somehow solve itself. That is exactly the kind of small administrative move that sounds dull and saves real money. People want exciting solutions. Wealth is built by boring systems installed early. Faysite Fayturn 490155, search 1 Fayturn 490155, search 5 Fay. The third mechanism is the distribution timing trap. This is where retirement gets expensive for disciplined people who did many things right. They saved in pre-tax accounts for years, they built traditional IRAs, they contributed to 401ks. They listened to perfectly sensible advice during the accumulation phase. Then eventually the government says, thank you very much. Now it is my turn. That is what required minimum distributions really are. They are the government's claim on tax deferral, finally coming due. If you own a traditional IRA or similar account, the government eventually forces money back onto your tax return, whether you need it or not. The law now generally starts that process at age 73, and the timing rules look harmless until you understand the ambush hidden inside them. Faysite Fayturn 490155, search 2, Fayturn 490155, search 6, Fayturn 490155, search 14. A lot of people hear that the first required distribution can be delayed until the 1st of April of the following year, and they think, wonderful, more flexibility. Sometimes flexibility is just a prettier word for a bigger tax problem, because if you delay that first withdrawal into the next year, you may end up taking 2 required distributions in the same calendar year, 2 tax bombs, 2 chances to push more Social Security into the taxable zone, 2 chances to step into a higher bracket, 2 chances to trigger Medicare premium surcharges based on income from 2 years prior. One administrative delay can echo for years. That is what I mean when I say retirement taxes are not about forms. They are about sequencing. The order of decisions matters more than the decisions themselves. A mediocre withdrawal strategy with good timing can beat an elegant strategy with bad timing. This is also why qualified charitable distributions are so powerful for the right retiree. If you are already charitably inclined and old enough to use them, routing money directly from an IRA to charity can satisfy required distributions without inflating adjusted gross income in the same damaging way. The same charitable intent can produce a very different tax outcome depending on which pocket the money comes from. That is not accounting trivia. That is strategic capital allocation. Faysite Fayturn 297,630 search, 0 Fayturn 297,630 search, 2 Fayturn 297,630 search. 11 Fay. The fourth mechanism is the gap year window. This is where the intelligent retiree quietly wins. Most people enter retirement and immediately ask one question. How do I minimize tax this year? That is the wrong question. The better question is this: how do I minimize tax over the next 15 years? Those are completely different games. If you retire before required minimum distributions begin, and maybe before Social Security begins, you often have a stretch of years where your taxable income is comparatively low. Most people waste that window because low income feels like a time to relax. In reality, it can be one of the most valuable tax planning windows of your entire life. That is when Roth conversions can make extraordinary sense. You deliberately move some money from a future taxable bucket into a future tax-free bucket while your rate is relatively low. You pay some tax now to avoid a much nastier stack later. You reduce future required minimum distributions. You may reduce the future taxation of Social Security. You may reduce the odds of crossing Medicare surcharge thresholds down the road. You are not avoiding tax. You are choosing the battlefield. That is what rational capital allocation looks like. Not asking, can I pay zero? Asking, where do I want to pay and under what conditions? I like that kind of thinking because it is businesslike. It admits that taxes exist. It refuses to pay them stupidly. And when markets are down, the arithmetic can get even better. If an account temporarily fell in value, converting during the decline means a smaller current tax cost on assets that may recover later inside the Roth. That is one of the rare times pessimism in markets can be used as a tax asset instead of endured as a psychological burden. People say they want opportunity. Usually they mean they want rising prices and easy optimism. Real opportunity often looks like temporary ugliness combined with good structure. That is what the Roth conversion window can be. The fifth mechanism is the Medicare ambush. This is the one that shocks people because it arrives late. A retiree can do a large IRA withdrawal or a chunky Roth conversion, or realize a large capital gain and think, all right, I paid the tax, I am done with the damage. Not quite. 2 years later, Medicare shows up with a higher premium because your income crossed a line you were not watching. The government has a separate little toll booth called IRMA. If your income goes over certain thresholds, your Part B and Part D costs jump. Not because your health changed, not because you used more care, because your income from 2 years earlier was too high. It is a delayed tax wearing a medical costume. That is why retirement planning is never just tax planning. It is tax plus benefits plus sequencing plus optics. A dollar is never only a dollar in retirement. It leaves fingerprints on every other part of the system. That is why one-time spikes in income can be so destructive. They do not simply disappear after April. They ripple. Now, if that spike happened because of a genuine life-changing event, there may be relief. But again, relief in this country usually has to be requested, documented, and chased. It rarely arrives pre-installed. The person who knows the appeal form exists looks prudent. The person who does not looks unlucky. In practice, the difference is education. That is all. Now, let me move from the traps to the protocol, because a list of dangers without a system is just anxiety. If I were sitting across the table from someone who had just retired and I had 1 hour to prevent the most common tax mistakes, I would tell them to install a retirement tax operating system immediately. First, replace payroll withholding with a deliberate payment system. That means either setting proper withholding elections on pensions, IRA distributions, and Social Security, or building quarterly estimated payments that mimic the disciplined payroll used to enforce. Do not wait for April to discover your own passivity. Faysite Fayturn 490155, search 0 Fayturn 490155, search 1 Fayturn 490155, search 8 Faysecond. Map every income source on one sheet of paper. Not in your head. On paper, Social Security, pension, IRA, dividends, interest, rentals, part-time work, brokerage withdrawals. Everything retirement punishes fragmented thinking. The IRS sees the whole picture, even if you do not. Third, run the provisional income formula before you decide on withdrawals. If you do not know how much of your Social Security is likely to become taxable before the year begins, then you are walking through retirement with your eyes closed. Fourth, identify your gap years and decide whether you are going to waste them or use them. Those years can be spent coasting or restructuring your balance sheet for the next decade. The wealthy are not always smarter, they are often just earlier. Fifth, never let required minimum distributions sneak up on you. The year you turn the triggering age is not the year to learn the rule exists. That is like reading the parachute instructions after the jump. Faysite Fayturn 490155, search 2, Fayturn 490155, search 18. Phase 6, if you are already giving money to charity, consider whether the source of that giving is optimized. A retiree who writes a check from a bank account may feel generous. A retiree who routes the same amount through a qualified charitable distribution may be generous and rational at the same time. I prefer the second version. Seventh, keep your address current with the IRS and open every letter. This sounds ridiculous until you remember how many people delay paying simply by not opening envelopes. The IRS treats deadlines like facts, not feelings. If you miss one, your explanation becomes decoration. Eighth, rerun the deduction math every single year. I have no patience for tax autopilot in retirement. Laws change. Caps change, circumstances change. A decision that was right 3 years ago can become a leak today. People lose money by assuming the old answer remains the right answer. In markets, that is lazy. In taxes, it is expensive. And now let me say something a little harder. Retirement reveals character when the paycheck stops. Some people become more attentive because they know nobody is carrying them anymore. Others keep behaving like employees inside a world that now requires owners. An employee says, "I assume somebody handled that." An owner says, "Show me the system." An employee says, "I did not know." An owner says, "What was knowable? And why did I fail to know it?" That distinction matters because retirement is not merely the end of work. It is the transfer of administrative sovereignty. You are no longer delegating your financial life to payroll departments, HR systems, and default withholding tables. You are now running a small enterprise called your household balance sheet. And the IRS does not grade on effort, it grades on execution. That is why so many perfectly decent people get hurt in retirement. They confuse innocence with protection. The world does not protect innocence. It exploits passivity. If you want a calmer retirement, do not focus first on rate predictions. Market forecasts, or what some talking head said the Fed might do next quarter, start smaller and harder. Know your payment system, know your withholding elections, know your provisional income, know your RMD year, know your Medicare thresholds, know your deduction choice, know which moves create chain reactions. That is not paranoia, that is adulthood with no payroll department. There's one more thing I want to tell you because this is where the mirror becomes uncomfortable. Many retirees spend more time researching a cruise than the tax architecture of the next 10 years of their life. They will compare balcony options, departure dates, and beverage packages with military precision. Then they will drift into retirement with 6 figures in tax, deferred accounts, no withholding strategy, no conversion plan, no charitable distribution policy, and no idea what income level triggers the next Medicare surcharge. That is not a money problem. That is a seriousness problem. The market can hurt you. Inflation can hurt you. A bad advisor can hurt you. But there is a category of damage that comes purely from neglect. And neglect is the most insulting kind because it was optional. I have never believed that getting rich was only about making more. A great deal of wealth comes from reducing unnecessary leakage. That is as true in retirement as it is in business. You do not need a miracle return to improve your life. Sometimes you need a tighter process, a better calendar, and the courage to stop running your finances like a passenger. So here is the contract I would make with myself. If I had just retired, I will not let the first year of retirement be an expensive experiment. I will not let my Social Security surprise me. I will not let required distributions stack on top of each other because I was lazy with dates. I will not let Medicare punish me later for income. I failed to sequence. Now I will not let a tax benefit go unused because no one put it on a glossy brochure. And I will not confuse the end of a paycheck with the end of planning, because the moment that paycheck stops, the IRS does not disappear. It simply waits to see whether you notice the machine stopped too. That is the threshold. And once you cross it, you have a choice. You can retire like an employee who thinks the old system still exists. Or you can retire like an owner who knows that every dollar now moves through a structure he built on purpose. The first path feels easier for a while. The second path is the one that keeps more of what you spent your life earning. There are 2 more blind spots I want to drag into the light because they look minor and they are not. The first is the senior deduction problem. Every few years Congress changes something, renames something, phases something in, phases something out, and half the country keeps filing. Like it is still 3 tax laws ago. A surprising amount of tax damage in retirement comes from stale assumptions. A deduction exists, a threshold changed, a rule became temporarily available, a preparer missed it, software failed to flag it, and the retiree never asks the one question that matters. What line did we just leave blank that legally could have reduced the bill? That is the discipline. Not trusting that the system found every advantage, verifying that it did. The second is the itemizing illusion. A lot of homeowners got trained years ago to stop itemizing because the standard deduction became more attractive under prior rules. So they keep repeating the habit long after the environment changed. This is one of the most common ways retirees file on autopilot. They think they made the itemizing decision once, years ago, and therefore they are done forever. Tax law does not owe you consistency. It changes if you live in a high-tax state, if your property taxes are substantial, if your mortgage interest still matters, if your charitable giving is meaningful, you rerun the numbers. Every year, no ego, no inertia, no attachment to what used to be true. The retiree who says, "We have always taken the standard deduction," is speaking the language of habit. The retiree who says, "Show me which route wins under this year's rules," is speaking the language of ownership. Faysite, Fayturn 490155, search 11 Fay, and because I do not want to leave this in the realm of abstraction, let me show you how the real damage often happens. A couple retires, they feel relieved. They are finally free of the office, the commute, the meetings they never needed to attend in the first place. One spouse starts Social Security, the other delays, they take a pension, they withdraw a little from an IRA to supplement spending, they sell some appreciated shares to help a grandchild, they do a modest Roth conversion because somebody told them it might be smart, then they forget that Medicare watches with a 2-year delay, they forget that more income can pull more Social Security into the taxable zone, they forget that underwithholding is not forgiven. Just because income sources change, they forget to retest itemizing. They delay the first required distribution because April sounds generous. No individual move looks catastrophic. That is why retirement tax mistakes are so dangerous. They are usually not explosions, they are stacks. A stack of small decisions that all lean the wrong way. That is why I keep returning to the same principle. Retirement is not a portfolio problem. First is a coordination problem. First, the money is often there. The structure is missing. Now, let me give you the blueprint as simply as I can. In the first 30 days after retirement, build the income map. In the next 30 days, build the withholding and estimated payment system before year-end, model provisional income, and test the Social Security taxation effect. Before your RMD year arrives, decide whether the first distribution happens in that year or the following spring, and know exactly why. During low-income gap years, decide in advance whether you are converting to Roth and how far you can go without crossing the next bracket or Medicare threshold before filing each return. Run the standard deduction and itemizing comparison from scratch as though you had never filed before in your life. And any time an IRS letter arrives, treat it like a fire alarm, not junk mail. That is the operating system. It is not glamorous. It is not dinner party conversation. It is also the sort of system that can quietly preserve tens of thousands of dollars over a long retirement without requiring brilliant speculation or heroic market timing. People often ask me what the secret is to financial peace in later life. They expect me to talk about some magic asset allocation. Usually the answer is much plainer. Know what can hurt you. Know when it can hurt you. Know the sequence in which it tends to hurt you. Then build procedures that make those outcomes less likely. That is all a good business does. A good retirement should be run no differently. You worked too long to hand your money back through avoidable mistakes. You endured too much to let a missing election, a stale assumption, or a forgotten deadline become the silent partner in your retirement. The final test is very simple. If your paycheck never returns, does your tax system still work? If the answer is no, you are not done planning, you are only done working.